Hello, credit union and other super savers. It took me a bit of time to dig up some of the answers to your credit union questions. So the bad news is that according to the NCUA, the National Credit Union Administration, there have been 256 credit union failures since 2009. And I'll be honest, 256 over that time period was more than I had expected. That's an average of 18 credit union failures per year between 2009 and the end of 2022. That's the bad news. The good news is that no member of a federally insured credit union has ever lost one penny of insured savings. I'm sure you're as curious as I was to learn more, so here's what I'll be covering in today's video. The advantages and disadvantages of banking with a credit union. How NCUSIF coverage, the FDIC equivalent for credit unions, works. What happens when a credit union fails? Plus, I'll go through when many of these credit unions failed, what the implications are for credit union folks in 2023, as well as what I believe to be a silver lining in all of this data. So let's dive in, my financial friend. So, here are the 4 advantages of banking with a credit union. Lower fees and better rates. Credit unions are typically not-for-profit organizations, meaning they don't have to pay out profits to shareholders and therefore are generally able to pass on these profits to their members in the form of lower fees and better interest rates on savings accounts, CDs, and other deposit and loan products. Personalized service. Credit unions tend to have a smaller, more community-oriented feel, which means you may receive more personalized service than you would at a larger bank. Membership benefits. Credit unions often offer perks and benefits to members, such as discounted rates or access to certain and/or exclusive products. Community involvement. Credit unions tend to sponsor events in their neighboring areas and raise money for local organizations. Now, here are the 4 disadvantages of banking with a credit union. Fewer branches and ATMs. Credit unions often have fewer physical branches and ATMs than larger banks, which may be inconvenient, for example, if you need to access your money while traveling. Limited services. Credit unions may not offer the same range of financial services as banks, such as wealth management or investment services. Membership requirements. Credit unions usually have membership requirements such as having a military affiliation, living in a certain area, or working for a certain employer, which may limit your options. Less technology. Credit unions may not have the same level of online or mobile banking technology as larger banks. So I'm assuming that you're with a credit union or interested in joining one if you're watching this video. So tell me, why did you decide to become a credit union member or future member? For one or more of these advantages that I just mentioned here, or some other reason altogether? Drop a comment below, let us know, and let's keep moving on to NCUA insurance. So, NCUSIF stands for the National Credit Union Share Insurance Fund and is operated and managed by the NCUA, the National Credit Union Administration. I use the terms NCUSIF and NCUA insurance interchangeably throughout this video. The NCUSIF, like our Treasury securities, are backed by the full faith and credit of our government and is essentially the FDIC equivalent for credit unions. The NCUSIF protects members' deposits if a federally insured credit union were to fail. This includes deposits in a share draft account, share savings account, or time deposit, such as a share certificate. And like FDIC insurance, NCUA insurance covers members' accounts at each federally insured credit union, dollar for dollar, including principal and any accrued interest through the date of the insured credit union's closing, up to the insurance limit. Also, like the FDIC, the NCUA does not insure money invested in stocks, bonds, mutual funds, life insurance policies, annuities, or municipal securities, even if these investment or insurance products are sold at a federally insured credit union. And if a credit union were to fail, the NCUA states that historically, insured funds are available to members within just a few days after the closing of the insured credit union. The NCUA does conduct regular operational reviews of all federal credit unions and works with state regulators to monitor state-chartered credit unions that are federally insured. Do note that the NCUSIF insures all federal credit unions and some state-chartered credit unions, which apply for and meet their insurance standards. And these insured credit unions must show their insured status at their offices and branches, as well as on their marketing material. Other state-chartered credit unions, which are not insured by the NCUSIF, may be insured by private insurance or guarantee companies that are neither affiliated with the NCUSIF nor backed by the full faith and credit of our government. You can go to this page, which I've linked below, to see if your credit union is federally insured by the NCUSIF. Just scroll down and enter the required information here and click the Find button. And here are the basic NCUA insurance coverage limits. For single ownership accounts owned by one person with no beneficiaries, the NCUA coverage limit is $250,000 per member owner. For joint ownership accounts owned by two or more persons with no beneficiaries, the NCUA coverage limit is $250,000 per owner, with the primary owner being a member of the credit union. For IRAs and other certain retirement accounts, the NCUA coverage limit is $250,000 per member owner. Again, remember that NCUA insurance only covers deposits in credit unions, not investment losses. So if the investments in your IRA account lose value, NCUA insurance will not cover those losses. And for revocable trust accounts, each member owner is insured up to $250,000 for each eligible beneficiary named or identified in the revocable trust, subject to limitations and requirements. Payable upon death, POD, and in trust for ITF accounts would fall into this category. Here's an example of what this might look like for me and my husband Marcus if we had accounts at a federally insured credit union. If I had a single account, I'd be covered for up to $250,000 from my account. And if Marcus had a single account, he'd also be covered for up to $250,000 for his account. And if Marcus and I had a joint account, we'd be covered for up to an additional $500,000 for this account. The coverage here is doubled because there's two of us on this joint account. This brings the total NCUA coverage amount to $1 million for me and Marcus at this credit union. And if we were swimming in cash, I wish we were, by the way, we could open the same three types of accounts at another credit union and get another $1 million of NCUA coverage at that credit union. And if I were to open a single account and add my 4 children on as beneficiaries, this would be considered a revocable trust account, and my coverage in this instance would also be $1 million. That's $250,000 of NCUA coverage times 4 for each of the 4 children that I've named as beneficiaries. The NCUA offers this detailed NCUA booklet on how your insured funds are protected, as well as this share insurance estimator if you're interested in figuring out what your NCUA coverage across all your accounts is at a particular credit union. I've linked both of these as well as the other resources referenced in this video in the description below. For those of you interested in contacting the NCUA directly, this is their phone number. Choose option 1. And their email. I can tell you though that when I called them for this video, they had higher than normal call volumes. I feel like I'm always calling places that have higher than normal call volumes these days, but maybe it's just me and what I do. In any case, if you call them, you can leave a callback number, which is what I did, and it took them about 4 hours to call me back on a Friday afternoon. Assuming you're still genuinely concerned about NCUA coverage after watching this video, it's worth the wait in my mind. Plus, you can just simply carry on with whatever you have planned for the day. Now, let's talk about what happens when a credit union fails. When many of these credit unions have failed in recent history. what the implications are for credit union folks in 2023, as well as what I believe to be a silver lining in all of this data. So when a federally chartered credit union fails, or when the NCUA deems that the credit union is in financial trouble, whether that's due to mismanagement, fraud, or an economic downturn, there are usually 3 different courses of action the NCUA can take, depending on the situation. 1. The NCUA may work with the credit union's management to develop a plan to improve its financial position. 2. The NCUA may take over management of the credit union, appointing a conservator to run the credit union until it can be stabilized and returned to member ownership. If this is not possible, then the credit union can either be merged with another credit union or liquidated. 3. The NCUA may liquidate the credit union immediately, meaning either shut it down or sell it to another credit union. In the latter instance, the credit union that is purchasing the failed credit union assumes the members' assets and loans of the failed credit union. Now, as I mentioned in the beginning of this video, there have been 256 credit union failures between 2009 and 2023. 2009 was as far back as the NCUA went on their website with this information. And as you can see here, about nearly 30% of these credit union failures happened during the last financial crisis, the Great Recession of 2008. Since then, credit union failures have been on a mostly downward trend, with a bit of a spike post-COVID here. And at the time of this taping, in the last week of March 2023, there have been 2 credit union failures so far. What we can learn from this chart is that economic stress and credit union failures go hand in hand, so to speak, like here with the Great Recession and here with the recent pandemic, which really shouldn't be much of a surprise. When times are bad, more companies will likely fail, more banks will likely fail, and more credit unions may be impacted and fail as a consequence. And while past performance is not necessarily indicative of future outcomes, what that also means is that it may be fairly likely that this small little bar here in 2023 with 2 failed credit unions will get higher, maybe even quite a bit higher this year or perhaps even next year, that there may be more credit union failures to come if there continues to be more turmoil in the economy to come, and in particular in the banking sector. Now, I did promise a silver lining in all of this at the beginning of the video as well. And in fact, I have 2 for you. I bet you didn't expect that, huh? The first silver lining is that failed credit unions in conservatorship are sometimes returned back to their members in a healthy, albeit smaller form. Here's what I mean. Just earlier this year, Edinburgh Teachers Credit Union, a Texas-based credit union, was released from a 22-month conservatorship and returned to members following a $2.5 million loss, lawsuits, and ousting of a highly compensated CEO. After nearly 2.5 years, the NCUA deemed this Edinburgh Teachers Credit Union no longer a hazard to public safety and healthy enough to operate with new management. To be clear though, Edinburgh Teachers Credit Union's membership did decline over 40% in the first month that it entered conservatorship, and its assets and loans declined along with that. But the fact remains, the NCUA did manage to save this one and protect members' interest in the process. And in one even more long-running case, the NCUA worked with AEA Federal Credit Union to get it back up and running in 2015. AEA FCU members reclaimed the credit union after 5 years thanks to operational improvements and strong earnings after it was put into conservatorship by the NCUA. According to the Credit Union Times, it seems liquidation of a credit union is always a last resort. So yes, even failed credit unions can come back to life in decent financial shape sometimes after a turnaround, or be merged with another one and continue as part of the combined new entity. Now, let's move on to the second silver lining, which I think is even more important and which I already gave you at the very beginning of this video. This statement from the NCUA that no member of a federally insured credit union has ever lost 1 penny of insured savings. That is the NCUA's promise to you as a credit union member. Keep in mind that insured is the key word in this statement. So what you really should do after watching this video is use the NCUA information I've provided you with. Check out the detailed NCUA booklet on how your insured funds are protected and the NCUA Share Insurance Estimator as well. And when in doubt, reach out to the NCUA to make sure that all your credit union deposits stay below the NCUA insurance threshold of $250,000. And just to be clear, this video is not sponsored by the NCUA or any other credit union. Many credit union members in our community asked for this video, and we simply delivered as customary. On that note, Super Saver, I hope this video was helpful and that it brings you a little more peace of mind during these crazy times, if you're already a credit union member or thinking of becoming one. And if you're interested in learning more about our top money to-dos during these uncertain times, then check out this video here that we posted recently. And as always, if you enjoyed this video, then don't forget to share it with those you care about. And of course, hit that thumbs up and see you again very soon with another brand new wealth building video.